It is H28. Now, you folks know what H is. That's the symbol. That's the letter for the month of March. Last Monday in March, Dan Nathan. This is Market Call. I'm Guy Adami. I'm always joined by Dan Nathan. But look, we're sitting next to each other. And you know why that is? Because we're coming to you live from CME Group in Chicago, Illinois. We are here, people. And today's Market Call is brought to you, guess who? CME Group, where risk meets opportunity. And of course, Open Exchange, because they manage the virtual meetings that matter. But effectively, this is not a virtual meeting. This is we're sitting next to each other. This is a real meeting.
Yeah, but it's virtual for anyone else who's watching it. You and I are here. You know what I mean? And we're actually overlooking the river right here. We're on South Wacker, right? And we're overlooking the river right there. And
Seine, River Seine.
That's not the Seine. That's in Paris. I was hoping there'd still be some of that green water in there. What do they do? No.
I think that sort of dissipates over time. Is my sense. It lasts for a few days post St. Patrick's Day. Then it sort of dissipates. Like most things, it flows into a larger body of water.
Dissipating right now?
Your attention span.
Remember that market sell-off that we were in the throes of just a couple weeks ago, and the market participants, at least in the equity markets, were kind of focused on a whole host of things that they haven't seen in a very long time. Stock market, I think the S&P was down 15% of its lows. The Nasdaq was down 23%, and they've actually had an absolute rip over the last couple of weeks. What's going on here, guys?
Last week was remarkable. The way the market came back caught me off guard. And listen, I think people try to explain it in retrospect. I have no explanation. I'm not quite sure what the market's looking at, but there's
hold on. Okay, Tuesday. Hold on. The day before the Fed meeting, I said to you, okay, and the market started picking up a little bit. We had that day on Monday, and I said Tuesday, the day before the Fed meeting, I said, Guy, do you think they sold the rumor and they're buying the news? And you said, matter of fact, that's going to happen.
But I never thought it would last as long as it did. I didn't think it was going to be as aggressive to the upside as it was, and here we are. So yeah, I thought it would be that by the rumor. I thought it'd be short-lived. And listen, I still believe this market has flipped from buying all sell-offs to now selling all rallies. I'm still there, although it's hard to hold on to that. But what do they call it when people, they put them clamp-ons on and they go out and they with the rope and
it's called mountain climbing, mountaineering?
Yeah, well, it's interesting because Tom Lee is talking about this whole wall of worry thing, which I have never used that example, but Tom Lee's bringing out a note, and he's basically saying, and I don't know if I agree with this necessarily, but equities have priced in the fact that the yield curve is inverting and all these different things going on with the Fed. Listen, he puts out a pretty cogent response to this and a pretty good argument. I just don't know if I believe it. Now, the market believes it right now. We'll see how long that lasts.
Well, here's the thing. You and I have talked about this for years. You think the Fed, I mean, they have this dual mandate. The dual mandate is what? Stable prices.
The dual mandate is to make sure the Nasdaq and the S&P 500 go up. And their other dual mandate is full employment, which we're clearly at. I mean, there's no question about that. And what was the other thing?
Stable prices.
Oh, stable prices.
So you don't think we have stable prices?
Well, if you watch the bond market over the last year and a half, it's anything but stable. But I'll save that, Dan. Please continue.
What I was going to say is, listen, Nostradamus. I mean, the point is now they have a quad mandate. And I just don't believe that everything that we don't know. And Tom's point is this, is like markets climb walls of worry, all right? And at this point, we've had this sharp rally off of those recent lows. We sold off into the Fed basically doing their first interest rate hike since 2019, and then they basically signaled that they're going to fight inflation very aggressively, right? And so if you think about what's going on right now, I mean, like, to me, okay, I believe that stocks at this moment in time, Guy, have priced in what they believe the Fed is likely to do in a way. And we're going to look at the CME Fed Watch tool, what's pricing in for the next meeting in May here. So the point is, he's saying market participants know what the Fed's going to do, but all that other uncertainty, Guy, that's the wall of worry. That's the stuff that I don't believe is really
when the Fed was accommodated for the last 13 years, specifically when they really threw fuel on the fire in the height of COVID. You could have said, well, we know exactly what the Fed's going to do. They're putting $4 trillion in the system. Correct. Market rallied for a year. Market rallied for a year. So the market knew what they were going to do, but the market didn't price that in. The market continued to rally. So I think the market understands what the Fed's doing, but to suggest that the equity market has priced that in at this point, I don't think you can do
All right.
that.
Well,
That's just my point.
No,
I mean, that's just my point.
I get what's different this time is all the uncertainty that we have globally right now. The globe was supposed to be in an endemic right now. We were supposed to have a reflation trade economically, not the consistent strains that we have on supplies of really important commodities and such. And so, like, taking the situation with Ukraine out of the way, I mean, like, that really is where we are supposed to be. Let's look at the S&P 500.
Please.
You just mentioned it here. Look at the futures here. We have a 1-year chart. I think it's interesting. I drew the line. You see it in red. It's horizontal here. We're right up below that kind of 4,600 level where the S&P futures topped out almost 2 times in February, right? And we had that kind of retest of the January lows here. We've had this rip, okay? Again, now we're down about 5%. We're above the 200-day moving average. That chart looks to me like it's basically going to need a whole heck of a lot of really good fundamental inputs as we get into quarter end. We know that we're going to have Q1 earnings coming in the next few weeks. I just don't see that as a catalyst for moving stock valuations higher.
That's what you have to ask yourself, folks. What's the catalyst? Obviously, listen, we've seen I think the S&P is rallied, 350 handles or so off the low, maybe more than that. What's the catalyst now? The bears had to prove themselves at the lows. They weren't able to. Now the bulls have to prove themselves, and we'll see if they're able to. I don't think they are. That horizontal line is exactly right. To the penny, as Carter would say, we are touching it. But look at that 200-day moving average. We point this out all the time. Lower left to upper right, effectively a trend line. It is flattening out here, and I would suggest it's going to start to turn lower. And we're going to there's going to be this battleground around the 200-day. And I think inevitably we're going lower. I'll say it again. I think 4,000 is the first logical stop. 3750 to me is still a number that's in my head. Now, Tom Lee obviously disagrees with that, and he might be right. Listen, that's been the right course of action over the last 13 years, is to buy any sell up. The market just sort of levitates higher. I just think given everything that's going on in the world right now, it's very hard to make that bullish argument.
Yeah, so we got to talk about rates here. There's a long distance of time. I think we're a little more than a month between the Fed's next meeting. We know that there's going to be a lot of Fed speak. We know that they like to jawbone stuff. The difference right now is when they're usually jawboning stuff, they're jawboning towards the dovish side, right? And that's giving kind of a bid to equities. Right now, they're actually talking about being more hawkish. Look at all the major houses on the street. They're talking Goldman sees, you know, treasury yields, curve inversion. The curve inversion, we're going to talk about that. We're going to look at the 210 spread versus the dollar versus the stock market here. But the CME Fed Watch tool, we keep a very close eye on it. We quote it every week here. It's pricing at a 50 basis point, about a 75% chance of a 50 basis point move. The one thing I'll say is that was the same case about a month ago for this meeting that we just had, and it did not come into fruition.
It was also the case prior to Russia, Ukraine. I think a lot of people changed their tune when that started. And now I think people are realizing that, wait a second, again, just my opinion, but inflation is a problem pre-Russia, Ukraine. It's clearly more of a problem now. And if peace were to break out tomorrow, the inflation problem that we had is not going to abate anytime soon. So I think a lot of these banks are realizing that, wait a second, maybe this is just, in terms of our world, a bit of a head fake. And a 50 basis point hike is appropriate. By the way, it's absolutely appropriate. That's what they should have led with. And there should be, between meetings, they have these, you know, mid-meeting rate hikes. You should see one of those. You really want to wake up call, do that, because
but hold on, that's really important.
That's really what they should be doing.
You and I, over the course of the last 20 years, we've gotten accustomed in crises, and this is what also is different this time, Guy. We are in a crisis right here. But the Fed's crisis.
Well, hold on. What's the crisis? The crisis is inflation.
Correct.
Yeah. So
they've never had that issue, right? So the before, when they would do a surprise rate cut, it would be actually just stoke inflation, right? Just stoke risk asset prices. And so your guess is as good as mine. If they come out and they do that between that early May meeting, I don't think it's going to be the thing that stock market investors would be happy to see. But let's look at this one chart, because this is kind of a weird one here, Guy, and I just thought I'd throw it up here. This is a 20-year chart of the S&P 500 versus the 210 spread here. And you can see the instances when it averted back in 06 and then again in 2019. And recessions did follow, no doubt about it. Stock market will continue to rally, I guess, into it until we really start to think, okay, the likelihood of a recession's here. That won't be good for equity prices. What does this chart say to you?
What it says, what's going to go on? I mean, again, the equity market is the yellow line there. I mean, again, lower left, upper right. But now the bond market, the yield curve is telling a much different story. And, you know, say the market's forward looking, to a certain extent it is. What that's telling me right now is the market still believes, for whatever reason, the Fed is still going to be accommodative at some point, and or this economy is going to resurge in the back half of this year. But I don't think either are going to happen. I think the Fed absolutely has to put the brakes on, and I don't think the economy is going to be nearly as robust, which means what? Means earnings go down, and you no longer have the Fed backstop. So you had complete tailwinds for the last decade or so. Those tailwinds at least now have gone away, if not become headwinds.
Well, it's funny. I mean, your point is if they go from this really, hawkish stance where they've signaled, 6, 7 rate hikes, and we know that some banks or strategists, economists are suggesting maybe 7, 8, 9 over the next year and a half or so. If they do flip the switch and they go back to being dovish, that means that we're
disaster.
A whole host of trouble. But here's the thing: this is the one reason why I think you have to be skeptical for the risk that this S&P at least could get back to unchanged, down only 5% in the year. Because we know that these massive mega cap stocks, tech stocks in particular, are driving the train here. If you look at the Nasdaq in particular over the last few weeks, the month of March here, you see that Tesla and Nvidia, the ones with that were like the $1 trillion names, or kind of I guess flirting with a $1 trillion market cap prior to the market sell-off. We know the mega names of Microsoft, the Apple, the Google, and the Amazon all were north of about $2 trillion or so. Those ones, though, the Tesla and Nvidia are interesting to me because they're more risk on, don't you think? The other ones, I guess, will do well in an inflationary environment, in a deflationary environment. Like they're the ones that are going to do well. What is Tesla and Nvidia up like that telling you?
Well, let's take the first three. I mean, let's look at Tesla, for example. Tesla traded down to $700 on the screws, has bounced since. What does that tell me? Well, I think part of it is the energy fears. I mean, people were piling into Tesla for obvious reasons, fundamental reasons. Right. I think the other thing is the news we're seeing today. Tesla's talking about a stock split, so I'm going to play. So that to me is obviously the juice for this. But that Tesla chart,
40% guy, 40% in 2 weeks, 40%. That's like $400.
And I've said this before. Is that a healthy move? I mean, think about what Alibaba did over the course of a day and a half. It rallied 50%. It's a $300 billion company. So this is not a healthy market. So your point is well taken, but I think we're going to go to that trend line that you drew, and I think we're going to exhaust ourselves there. So again, why did Tesla rally? Those are reasons. You talked about NVIDIA, and we can talk about the reasons why there. But this Tesla, I think, the only reason the Nasdaq has any legs today, obviously, is on the back of this.
Yeah, well, let's look at the Nasdaq 100 futures here because, look at this thing, and I think it's interesting. It looks very different than the S&P 500. Obviously, it sold off, to a larger extent. So, really worse relative strength to the S&P 500. We know that there's lots of names that are down 50, 60, 70%. Those major names, though, I don't think any of them were down 20% at their lows. When I say the Microsoft, the Apple, the Google, the Amazon, and they kind of really held it together, but it's still below its 200-day moving average. Again, just like that kind of 4,600 level in the S&P futures, that 200-day at 15,115 or so, that to me looks like a good level to take a shot as we go into quarter end. The potential for guide downs or negative pre-announcements in early April and into earnings season, I think you want to fade it.
I agree with that. And if you look at this, you mentioned this is not nearly as good looking a chart as the S&P was in terms of futures, without question. Here, we have not breached the 200-day moving average to the upside. We're trading right up to it. And if you look at that high we made 4 or 5 months ago, the S&P made a new all-time high. The Nasdaq was unable to do that. That's something to keep into consideration. And again, the 200-day moving average, lower left, upper right, flattening out. If we have that rollover that I think we both think is coming, that 200-day is going to start to roll over as well. And then I think taking out those lows we made literally just a few weeks ago, I think is inevitable. And you mentioned the reasons why. And I think they're all right in front of us. Listen, you've had a heroic move in Apple from that sort of 153-ish level. I mean, think about where we rallied up to back in news last.
That's a good segue. You know why? The Apple? Were you going there?
Well,
did I just jump the gun?
I mean, go ahead.
No, I don't know. I know. I thought it was really interesting because even today the headline is because I'm sorry. Because the Chinese are locking down.
Remember in Ocean's 11 when Brad Pitt?
Clooney? You're Clooney. I'm Pitt.
I'll be Clooney.
Ish?
Well, but not that anybody particularly cares. But Brad
agrees.
Pitt was born on December 18th, 1963. Oddly enough,
exact same birthday.
Exact same birthday. Now, the scene I'm talking about is when he gets Brad Pitt out of jail and they go in the elevator and he has this little thing he says. And then Clooney says to Brad Pitt, "Did I rush it?" And Brad, just a little bit you did, but that's what you just did.
All right, but let me ask you this: what was one thing that Brad Pitt was doing throughout that entire movie? There was
he was eating.
Yeah. Yeah.
I loved it. He had like yogurt,
whatever it was.
or
It was just
fruit
some
salad.
All right, we're getting
Brad
off the rails
Pitt-
there. Sorry
a little bit,
about
sorry.
that.
Please
All right, but here's
no,
the thing I was going to say.
yes, Apple and what's going on in China. You're 100%
That's
right.
where you're going.
Please.
Okay. Well, I mean, listen, they just locked down a city of
25 million people.
Yeah. So Apple's cutting down
A city of 25 million
crazy.
people. That's crazy.
That's like the Central America.
So think about that. And again, so with all that's happening there, obviously,
but it doesn't budge.
Doesn't until it does. I think again, for Apple specifically, I think the market participants seem to be using that as a safe haven asset. They're like, you know what? We're going to get out of some of these high valuation, high growth names. We don't want to be out of the market entirely. Let's find a place that we can sort of wrap our head around in terms of valuation. You would say correctly that, you might think you're in for valuation reasons. It's not nearly as cheap or as inexpensive or as attractive as you would think. It's Apple, I get it, but at 27 times earnings with the earnings growth and the revenue growth that they're seeing, it doesn't make sense in this environment. If that was any other company with those metrics, you'd be like, you got to sell this name.
Yeah. So the China thing is really interesting just in general as it relates to Apple, because we know that a lot of their manufacturing, a lot of their parts, a lot of demand, a lot of future demand, comes from there. And so when we've been talking about this a little bit, where a lot of US multinationals, they cut off sales to Russia, right? And so if there was something, and we're going to talk about this, probably for the next few months or so, if there's some sort of dust up, as you've been saying, with China and Taiwan, and we know a lot of production happens in Taiwan. We know Taiwan Semiconductor, we know Foxconn, Huawei, these are companies that are, some of them are Taiwanese and they do a lot of stuff in China. That could be an issue. But let's talk about crude oil here, because that's the impetus, that lockdown for this dramatic move lower here. It's held that uptrend. You've been on this call from the low 60s. You thought we'd get to 100, and then you said we get to 120. You thought we'd see a pullback here. Is this kind of just a back and fill? Or if you look at that uptrend that we have, and you see the 200-day guy all the way down there near $80, if there was a de-escalation in the situation with Ukraine, is this thing going right back to 80?
Well, that's the next leg lower. So what you just described is the reason why crude probably gets back to that $80 level, and effectively, though, still being an uptrend that we've been in for quite some time. The fundamentals of oil have been in place not only for the last 6 months, probably the last 18 months, and now it's starting to come to fruition in terms of the price. Yes, I thought we'd trade 120. It did. We thought it would back and fill. It did. And then I thought we'd have another leg higher. We did. Today's move is disappointing for the bullish thesis, obviously on the back of the news that you just mentioned, so I understand it. I don't think it's over. Now, it's really hard to make that argument when you see it down 8-9% in the course of a day, but I think everything is still in place for crude to continue to go higher. Today, notwithstanding.
All right, so let's go back to October, November. Let's go a little time machine here. We did not.
I like that.
We did not have Omicron yet. Okay, we did have Delta in Q3, and we saw that there was some volatility. I think crude oil topped out in the mid to high 70s during the Delta period. Then we came in, and the whole fear is obviously global slowdown, pushing out the recovery, that sort of thing. Then we got back. We made a new high in crude. We got basically back to 80, sold all the way down to 63. So I guess a retest of that fall high would kind of make some sense, given the uncertainty that, listen, China locks down cities of 25 million people, and we're talking about maybe tens of thousands of cases here, which are really a situation that we still have in America right now.
So the question you have to ask yourself is crude, let's play it out. If crude goes down to those levels, if you have another 15-20% move in crude from where we are right now, is that bullish or bearish for equities?
That's where I was going next. I mean, to me,
that's what happens. Sometimes you're in somebody's head, you can't get out.
Kind of share
they call that an ear bug.
But that actually speaks to, I think, some of the things that Tom Lee's talking about. What's priced into equities right here? What's not priced in possibly is crude oil going back towards $80 or $75, and that could be the thing that has the S&P unchanged in the year. I did get an email from somebody, Tom, who likes to kind of pick at some of my commentary on Fast Money on Market Call. He thought from when I got left for vacation in early March to when I got back a week and a half later, he thought I'd changed my tune. What I'm trying to do is think about what are the ways that I could be totally wrong on the S&P move, and that would be it. I think if you saw, commodity prices come in, that would signal that maybe the Fed has the opportunity to take their foot off the pedal a little bit, guy.
Do you know who Burgess Meredith was?
He was Mick. First of all, he played a lot of things, but Rocky made him famous.
He was, I think he was in the Batman too, back way in the day.
The original show.
No, but you asked me why.
You saw that first run.
I did. You say, why you bring it up? Because in Rocky 2, I believe, they're in a ballroom when Rocky was working at. They weren't in like a gym.
No, that was Rocky 3, actually.
Whatever.
He thought he sold out, basically.
He totally sold out.
Yeah.
And then there was a piano player playing the
Yes,
Rocky theme,
correct.
and Burgess Meredith Mick said, change your tune. So
Yeah,
anytime I hear
yeah,
people say
yeah.
change their tune,
Oh yeah,
you don't care.
that was
You're
great.
not. My point is, you're not changing a tune. They didn't change their tune in that
Yeah.
movie. You're not. You're just looking at it through a different lens. You're trying to be thoughtful about this. What can I be missing? I think that's exactly right. I ask myself all the time, what am I missing here? Because I'm wrong all the time, as you know. So I'm just trying to learn from my mistakes.
Well, here's one thing. I think it was interesting in Rocky 3 because he went Hollywood. He was wearing gold trunks. Okay.
Yeah, he was.
And he was wearing gold trunks. And you never changed your tune on the shiny metal.
Maybe I should
here.
have, though.
Well, I mean, listen, it's still acting pretty decently here. We have a chart, and we got to look at this. This goes back 20 years. You used to trade. I think this chart goes back. No,
I started a lot longer.
Okay, fair enough. But look at that thing. This is not a log chart here. And I know some of you guys are going to say chart foul, this and that, throw a flag or whatever. But the lines, they line up pretty well. Those highs there. And look at that thing. We got to a new all-time high briefly. And you and I have been talking about it. Why is gold acting this way? We're going to get to Bitcoin in a second. But Bitcoin, which is the digital gold, why was that acting so poorly with inflation readings at 40-year highs? This chart is still pretty constructive here, guy. I think Carter might say cup and handle sort of thing or whatever.
I don't know what that is. Look, I'd like to think it's constructive, but it's, you trade up and make those double tops. I mean, we topped out at the levels we saw in August 2020, and we sold off like, see, I did that. I was worried that I was going to make the snap, but I actually did it pretty well. That's not particularly encouraging. Again, if it were anything but gold and you said, God, how does this look? I'm like, I don't know. We sort of topped out. We couldn't get through those highs. It doesn't look all that promising to me. I still believe in the gold story. I still believe there's more chapters left here, the same way I believe in crude oil. I'll say this, and this is important. Gold is a commodity in name only. Crude oil is a commodity. It has an end use. There's no real end use here. So it's a little bit of a different animal. But I do think the world shakes out right now to the benefit of the gold bulls.
Yeah, I just say near term, we have a 1-year chart of gold, the gold futures here, and you look at this thing here, it's still pretty constructive. You see that breakout level from February. You saw that spike. It's reversed here. It's kind of holding that near-term uptrend well above that 200-day moving average, which just flattened out. So that tells you it's definitely in consolidation mode, guys. I don't really think we're done here yet, but I will say this, and if I asked you this question for 2 different movies, okay, 2 different groups of movies here, there's some interrelation between the Rocky movies and your favorite, the Godfather movies. And there is Talia Shire.
Oh no, that's the commonality. But in terms
here's the other commonality, and I think this is widely known. If you said best Godfather and best Rocky, they both start with the same number.
2. I'll buy that.
Is that fine?
Commonality. I like that.
Okay, well there you go. All right, let's.
Well, I will tell you, the original Rocky, that won Best Picture, didn't it?
I think Rocky 2 also won Best Picture.
Challenge.
The Godfather 1 and 2 both win Best Picture.
I believe Godfather 1
we can go.
and 2.
Someone tweet us at guy on that one.
I'm looking down because we have questions coming in, Dan. But please continue.
All right, well, let's just quickly hit the dollar here, the U.S. dollar index. That is the Dixie here, and we know that from the last time that the Fed started to try to normalize interest rates, they were doing it for different reasons. Back in 14, 15, 16 or so. We know that the dollar started to rally, and interestingly enough, crude oil went the opposite way, and crude oil was exasperated those moves when the dollar started to spike. Here's a long-term chart of the U.S. dollar index here, and you look at this thing going back to those prior periods here. Look at where we found support. And you and I were talking about that 88.90 level for a while. What did it mean all there? The dollar coming in, U.S. multinationals kind of liked it. Do U.S. multinationals like a strong dollar with strong commodities? Not exactly. I'm just curious your take on the Dixie here, because obviously gold is very much.
It was a year ago where I thought the dollar was going to collapse, and that was actually looking like the right call. And that 88 level, which I thought we'd go through, like, I won't say what through a goose, but that's what I thought would happen. It did not happen. Now, obviously, a lot of things have changed course. I think people are looking at the dollar as a safe haven one, which is interesting.
But that's really relative to the euro, which is
relative.
Right.
But also, obviously, this is a Federal Reserve that has made very clear they are changing course, and that should be extraordinarily supportive of the dollar. The reason why, in my opinion, the dollar isn't even higher than it is now is because you have other central banks lining up exactly the same way. So just when all these central banks were accommodative and dollar was coming off, you have now central banks trying to be responsible, which I think is mitigating the upside move. I still think there's room to the upside in the dollar. And almost by definition, if that happens, it's not supportive. I won't say it's a headwind for equities, but it's not the tailwind that it's been with a weaker dollar.
I mean, listen, I mean, the point that you and I would say is that, equities have headwinds right here. You look at the 1-year chart of the Dixie and you look at that breakout from that really nice uptrend that's been in. It's really, you buy every dip there. That looks like a really nice consolidation to buy. So, your guess is as good as mine as far as what that means for U.S. corporate earnings guidance going forward in a, I think in a, with visibility is about as clear as mud. All right, let's hit this here. We're at CME. We're in Chicago.
We are.
We know they trade a lot of futures.
It's nice outside too. Look behind. I mean, it's a beautiful day.
It's anything but nice. It's literally in the 20s.
Well, it's
here.
cold.
I'm just saying, but this is not, this sort of weather's not for me.
We have CME Group tweets. By the way, you should follow CME Group because I do, and I retweet their stuff religiously, as it turns out.
They follow us.
Look,
too.
CME
really
Group
nice.
just delivered new options to help you manage cryptocurrency price risk. That's important. I mean, the price. Think about what crypto's doing.
All right, without shilling, let's just talk.
I'm
about
not
this.
shilling.
No,
it's important.
So a couple months ago, they reached.
I didn't even know how to spell shill. I think there's an S in the beginning.
They had a very important milestone with Ethereum micro futures, and so we had Brian Kelly, and he came on, and we talked about this, and we had a gentleman from CME who is a product specialist, and we're talking about, okay, so all of a sudden now we're seeing greater institutional adoption. Forget retail, I got my Coinbase account. I trade, spot, this and that, whatever. The main story, you don't. We're going to work on that.
No, I was going to say, you promised to do it on live television.
Oh, we're going to do that. We'll do it on a market call, actually. Okay. But here's the bull case to me about the adoption. And our friend Brian Kelly talks about this a lot, is institutions, buying these crypto assets. I'm going to call them crypto assets. But what really is making institutions get more comfortable with doing that are all the ways in which they can hedge them, they can leverage them, that sort of thing. So you have micro futures, which are great, I think, for a whole host of different investors, because obviously the contract size is really important. But now there are options on these sorts of things. So I just think that keep an eye on the volumes of these things. Greater volumes means greater adoption. Greater adoption means better tailwinds, I think, for retail investors who are looking at these products. But we got to look at the chart.
You got to look at the Bitcoin. And quickly, I know we're running out of time, but I'll say this. If you think about all the products, all the things that CME trades, they have an effect on your every single thing you do every day of your life, whether it's buy a home, mortgage, groceries, energy, any of those things. And now crypto, which is becoming, to your point, pretty widely used. So good for them once again ahead of the curve. Back to you.
But think back to this guy when you were trading commodities, let's say 25, 35 All right, 35 years ago. Yeah. Okay. At the time, there was only, you traded the spot, right? And you had the futures, and they traded on CME.
Which, by the way, is the reason I bring up the different months. By the way, in April is coming up, as you know.
I know it's drilled into your head.
That's a J.
Yeah.
April is
yeah,
J.
but I guess the main point was think about when you started seeing other products being layered onto them. It gave you different opportunities, I guess, that, for hedging and risk management, that sort of thing. And I think that's the main story. Let's look at this Bitcoin chart here, because you know what? This thing looked like it was stuck in a range down, 30, 40% or so from those November highs. My guess would have been it was going to be breaking that uptrend that had been in place. And that uptrend, I don't know, since the summer was kind of precarious at best. That's a really nice breakout about the 200-day moving
100-day.
average.
It's a great trend line above the 200-day moving average. 32,000 with support. You drew the lines. I mean, traded down there a couple times, bounced. And now you're starting to see a pretty meaningful bounce. What does it mean? Well, I think you trade on the long side against either that downtrend line or probably better, the 200-day moving average. The risk reward probably sets up a little bit better against the downtrend, but at least you know exactly what your risk is against the 200-day. So if you looked at this and didn't know what it was, textbook breakout, risk rewards were very well defined. Looks pretty good to me.
What's interesting is that, our friend, again, Brian Kelly, we're going to keep giving him shout outs, and CNBC's Fast Money.
Right,
well, he might be, but he calls it our radio show, but it's really a live streaming video show. But, this has become a macro risk asset is what he says. And that's really interesting to me because it's still only about 2 trillion if you look at the market cap of all the products. Now, obviously, VC and a lot of the stuff that's going into kind of some of the different protocols. And we know that there's, tons of NFTs, which are also financial products. That sort of sentiment towards these things is really driving a lot of price performance. Why do we focus on the charts? Because they line up pretty well. They trade pretty technically, and
Now they do. There's enough body of work that you can actually look at these things.
And I guess the other thing is keeping eyes on these levels. Sometimes when we see these big moves, we're seeing stops being taken out in the futures markets, or they could be strikes in the options market. So that's really important. One of the ones, and you know that I've talked about this a lot,
The
Ethereum. ETH. Yep, we got it.
Is that they call that?
They call it the ETH. We have the micros here. They also have options on the micros we just talked about. Look at that thing. That
Even
is
better.
a bit of a rip. And this is one I can put my finger on, and I can say, when you think about DeFi, and you think about TradeFi, and you think about NFTs, and you think about the move to proof of stake, which should happen at some point this year, which should be economically or environmentally more friendly, and then obviously could be a bit deflationary once you actually lock up a bunch of the existing ETH. To me, this one is interesting. I buy it on dips. I kind of think if you have a move back to that downtrend, you want to buy it at the convergence of the uptrend and the downtrend. How's that guy?
I think of hi-fi. When I was a kid, we used to have the hi-fi in our living room.
Yes,
we used to put it on.
Did you see that? I tweeted that thing. You were tweeting at the fan. You were tweeting at your buddy the fan.
Sure.
You didn't even respond to it. It was an old guy, an old-timey guy with a big, a big
Megaphone.
radio. No, it was a big radio. That's how you started listening to the radio. But before we got
out of here, I was going to say it was an RCA radio, by the way.
Okay.
So now that Bitcoin appears to be breaking out, you say to yourself, who would be a really good guest for market call?
Okay.
If you could have a wish list of guests, given
when it comes to the Bitcoin,
who would you want on market call Tuesday, which is tomorrow?
Satoshi Nakamoto.
He was busy. Okay. I reached out to him.
Do you have him on the blower?
I do, actually. I have his digits here. No, Michael Saylor, CEO and founder of MicroStrategy. He is joining us tomorrow
on
1 p.m. Eastern time, market call, the whole half hour.
You know what's so funny? He could be Satoshi Nakamoto. Would that be the most amazing? That would break the internet.
Should we ask him? Are you allowed to ask him that?
Well, I don't know. That would be doxing him. Do you know what doxing somebody is?
I got my pay doxed years ago when I was a lifeguard because I did something.
All right, listen. So Michael Saylor, CEO of MicroStrategy, they own 125,000 Bitcoins on their balance sheet. He's going to join us market call tomorrow, 1 Eastern.
That's it, 1 Eastern. We're here, so it's set.
We're Central
CST.
Standard. Yeah.
Throws me off a little bit. Like when we got off the plane, it was earlier than we got on the plane today. It's a crazy thing. Weird. But that's it. Wrap this sucker up, Dan, because we got to get out of here.
It goes like this. Are you worried there's no copy in the
thing? No, the copy's right there. That's it for market call. Once again, thanks to our sponsors. We're here at CME Group. Where risk meets opportunity. It was a risk for them to have us here, but it's an opportunity for us. At Open Exchange, they manage the virtual meetings that matter for the top companies around the world. Hopefully you enjoyed this. I did. Tomorrow, same time, 1 p.m. Eastern time. As I mentioned, Michael Saylor, CEO of MicroStrategies, will be with us.
Can't wait.
Later.
See ya.